Okay, we are back. So we're on slide 3 of deck number 6, and we're going to talk a little bit about mostly debt for the next little bit, but generally about issuing debt and equity and how those things work before we get into the more complex parts of the corporate distribution regime, which generally deal with how dividends work. So, issuing shares or debt. Effectively, for a corporation, it's a non-event, right? When a corporation issues a share from Treasury or issues a debt for the first time, this is because paragraphs L and M of the definition of disposition in subsection 248(1) provide that the issuance of a share or the issuance of a debt is not a disposition by the issuer corporation. And so that, when you think about that, since the income tax is effectively a transactional tax, then since the income tax is effectively a transactional tax, if there's no disposition, then there's nothing that we can actually impose any tax on. So non-event for the corporation. For the shareholder, however, the tax consequences of a corporation issuing a share or a debt to the shareholder depend on what the consideration given by the shareholder was for that share or that debt. Because the corporation is a separate legal person from the shareholder, like we've talked about, and so any combination of subsection 69(1) or common law principles or the definition of proceeds disposition in section 54 is going to result in the shareholder having proceeds disposition equal to the fair market value of the share or the debt received in exchange for the transferred property. And so the shareholder could have a capital gain or capital loss if they've paid with a property other than money. If the shareholder is paid with the property that is money, then the issuance of the share or the debt is effectively a non-event in that case as well. The shareholder will have an adjusted cost base in the share or the debt equal to the amount of money paid to acquire the share or the debt. And we're not going to have any event for tax purposes until there's a distribution on the share or debt or until the share or debt is disposed of. We can flip to slide 4. We can talk about options, and options are basically the same deal for a corporation as a share would be. A corporation granting an option to acquire a share of the corporation from Treasury is deemed not to be a disposition under paragraph 49(1)(b). And for the shareholder, acquiring an option initially is basically the same thing as acquiring a share. So the option holder gets a cost in the option equal to the amount paid for it. And so if they pay for the option using money, then that's a pretty straightforward transaction, right? There's no immediate tax consequence. You have ACB in your option equal to the amount of money paid for the option. Where stuff does happen is where the option either expires or get exercised. So if the option expires without being exercised, then subsection 49(2) applies, and it deems the corporation to have disposed of a property with nil ACB for proceeds of disposition equal to the amount that was originally paid by the shareholder for the option. And the result is going to be that the corporation is going to realize a capital gain based on the amount of money it effectively got for doing nothing, right? The shareholder is deemed to have disposed of the expired option under subparagraph B4 of the definition of disposition in subsection 248(1) and will therefore realize a capital loss equal to the amount that they had initially paid to acquire the option that they allowed to expire. If the option is exercised, then generally speaking, it's a non-event for the corporation. Again, because what the corporation has done is it's issued a share, ultimately when the option is exercised. And so paragraphs L and M of the definition of disposition would just apply to deem there to be no disposition. So whatever subsection 49.3 says about the corporation is effectively irrelevant. And the amount paid for the option, probably under corporate law purposes, you're gonna add that to the stated capital of the share that's ultimately issued when the option is exercised. Paragraph 49.3b applies to the option holder, and that is relevant. And what that provision provides for is that the now shareholders' cost of the option gets added to the shareholders' ACV of the share, in addition to whatever the cost of the share otherwise determined was, so whatever the strike price of the option was when it was exercised. Again, if the shareholder pays the exercise price under the option using money and not any other form of property, then there shouldn't be any other tax consequences upon the exercise of the option. It should be basically a tax-free event. Again, assuming it's not an employment stock option, but we can ignore those for the time being. And the result is going to be that the shareholder will have tax consequences determined when the shareholder receives a distribution on the share or when the shareholder disposes of the share. Next, we can talk about the flip side of this if we flip to slide 5. And this deals with debt, and more specifically the cancellation of debt. So basically, what will happen when a corporation repays or cancels a debt depends in part on how the corporation actually goes about repaying the debt. So to keep this simple, let's assume that the corporation is going to acquire, cancel, repay, etc., the debt using only money and not using other property. So if a corporation repays a debt in full and on time, or has purchased its debt in an open market for corporate debt for an amount equal to the face value of the debt, then nothing happens, right? It's a nothing for the debtor. The creditor would have a disposition of the debt, which we'll talk about later, but for the corporation, it's a nothing. Where things do happen is where the corporation has paid more or less than the face value of the debt in order to retire the debt obligation. If the corporation has directly compromised a debt by paying the debt holder less than the face value of the debt in full and final satisfaction of the obligations under the debt, then we have, in all likelihood, the debt forgiveness rules in Section 80 that would apply, because there would be a forgiven amount equal to the difference between the face value and the amount the creditor actually accepted, and the forgiven amount will result in tax consequences under subsections 80 sub 3 to 13. We're not going to talk about Section 80 in this course unless we have extra time at the end and people are really bored and want to learn about how Section 80 works. Suffice it to say that nothing good happens when Section 80 applies because you have a debt forgiveness. Sometimes what happens under Section 80 is less bad than the alternatives, but it's still not actually good. So having debt forgiveness is a bad thing, and people will, unless there's compelling commercial reasons, for example, because you have an opportunity to retire a debt for much less than what you think its fair market value is, people try to avoid having debt forgiveness if they can get away with it. If the corporation acquires a debt in the open market, so if the corporation is a public corporation and its debts are publicly traded as well as its securities, and the corporation just hires a broker or an investment banker to go onto the market and acquire the corporation's debts, then subsection 39.3 will apply to that open market acquisition, and it will deem the corporation to have acquired to realize a capital gain if it pays less than the face value of the debt to acquire the debt on the open market, and it will realize a capital loss if it pays more than the face value of the debt to acquire the debt on the open market. So at this point in the course, about half the number of years that I've done this, somebody will now ask the question of why would a corporation acquire its debt on the open market for more than the face value of the debt? I usually, most people, this is, I think, second nature to those of you who were, finance people in undergrad or in a prior life, or MBA types, which I think some of you are. It's all about the interest rates, right? That the corporation, if the corporation's debt has a very high interest rate on it, let's say, and interest rates have dropped, and the corporation could issue new debt at a lower interest rate, it may be that if and depending on how the market pricing is looking, it may be that it's the corporation's advantage to acquire debt in the open market in order to retire that debt upon acquisition, even if it's for more than its face value, in order to just reduce the corporation's interest costs going forward. So that's why you would do it. And if you're on the flip side, you're the creditor, you're the person who holds the debt that's being traded on the open market. The reason why you might want to dispose of the debt for less than its face value, even though it might be, for example, like a AAA rated type issuer, when you're going to get paid eventually, is that if interest rates have gone up since the debt was issued, you might be better off taking less than the face value of the debt so that you can reinvest what you get at a higher interest rate. And it all just depends on what's being offered by the issuer corporation. So it's not a thing that will never happen. It's a thing that actually happens all the time, probably on a daily basis, where rational people do enter into transactions like that. So for the finance people, that was probably a very clumsy explanation of why that is the case. And for those of you who are not finance people, or economics people or whatever, hopefully that made some degree of sense. So then on the creditor side of these transactions, paragraph B of the definition of proceeds of disposition provides that when you retire a debt, the creditor has disposed of the debt for proceeds of disposition equal to the repayment. So basically, if you got paid in full and on time by the corporation as a creditor, it's going to be a non-event for tax purposes. You're going to have a disposition for proceeds of disposition equal to the face amount of the debt, which should equal your cost amount of the debt unless you acquired it at a discount or something, but probably a non-event, especially in the private corporation context, but that stuff doesn't really happen. If you received more than the face value of the debt and more than your cost in the debt, you'll have a capital gain, and if you receive less, you would have a capital loss. So fairly straightforward from the creditor side of the equation. So everybody okay with that so far? Okay. Moving on to slide 6, canceling shares. What I would say is we're not in a very good place to talk about canceling shares just yet, simply because a lot of what happens with the cancellation of a share is, certainly from the shareholder perspective, dealt with under subsection 84.3. And we're going to talk about that in a few weeks. We talked about deemed dividends and deemed corporate distributions and how that would work. So bear in mind that some of this may not make total sense right now, but see if we're going to keep it at a very high level for now. So repurchasing shares by a corporation, where it's the corporation is acquiring its own shares. Generally speaking, not an event for the corporation. The corporation is, again, assuming it pays only in money, It hasn't disposed of any property, so there's no gain or loss of tax, and it's not acquiring anything because the share basically just ceases to exist upon its repurchase. And if there was any potential of a deduction for the payment that's being made to the former shareholder, paragraph 18(1)(b) would deny that payment because it's on account of capital. So it's pretty close to a non-event for the corporation unless the deemed dividend has effects on the corporation, like a refund of RDTOH, which again will make materially more sense in a couple weeks. What we can say is that canceling a share is a potentially big deal for a shareholder. Like I said, dealt with by subsection 84(3), but also subsection 84(9), paragraph J of the definition of proceeds of disposition in section 54 also come into play, and various other provisions depending on whether the shareholders are resident or a non-resident and whether the corporation is a private corporation. So a bunch of other things come into play. But in essence, what will happen is that the shareholder will be deemed to have disposed of the share for an amount equal to the stated capital of the share, which could result in a capital gain or capital loss if the stated capital of the share is other than the shareholder's ACV in the share. The shareholder is also deemed to have received a dividend on the repurchase of the share, and the deemed dividend is basically equal to the repurchase price of the share less the stated capital of the share at the time that it's repurchased. So, that can be a material difference. For example, if we just dispose, we're going to talk about this later. If we just dispose of the share, you probably have a capital gain or capital loss, right, based on your ACV versus your amount realized, your proceeds disposition. On a share repurchase, if there's a difference between stated capital and ACV, the difference between stated capital and the repurchase price becomes a dividend, and then the stated capital versus ACV determines your capital gain or capital loss. And so it may be that, for example, if the shares have a low stated capital, for example, because you bought, again, to use Royal Bank as an example, you bought common shares of Royal Bank. It's been a publicly traded corporation for eons. The stated capital of any one share of Royal Bank is probably functionally zero. So if Royal Bank repurchased your share, probably the entire thing would be a deemed dividend as opposed to a capital gain. And so that's a bit of a difference, right, between a repurchase and an actual sale of a share. Like I said, for a corporation, repurchase probably not a substantial event unless the deemed dividend causes tax effects for the corporation, which again we'll talk about in a couple weeks. So moving on to slide 7, and interest or dividends in slide 7. As I mentioned earlier, corporations have a preference for paying interest rather than dividends, especially if the shareholders or creditors, if they are the same people, are not economically identical to the corporation. Like it's not a single shareholder corporation. Because provided that the requirements of paragraph 21C are met in respect of the borrowing, then the corporation can deduct any interest that's payable on the bond, debenture, note, mortgage, operating line, whatever the form of debt is, in computing its income from a source that is business or property. In contrast, the payment of a dividend is generally viewed as a payment on account of capital by the corporation that's made from its after-tax profits. And so paragraph 18(1)(b) would apply to deny the deduction of the dividend in computing taxable income. So, a fairly significant bias, right? As long as you meet the test under paragraph 21C, whether you meet the test under paragraph 21C has been the subject of some of the most famous tax litigation ever to have happened. Generally speaking, what that test requires is that you have your debt has to be a loan, so there has to be a lender-borrower relationship, or it has to be the unpaid balance of the purchase price of property. Either the borrowed money or the property, as the case may be, has to be used for a current direct income earning purpose, other than the purpose of earning exempt income, and the amount of interest has to be reasonable in the circumstances, which basically means it has to be the market rate that that lenders and borrowers would charge in an active market for the corporation's debt. So usually the reasonableness is not a point of contention because everybody knows what the bank charges, but the current direct use is usually where battles over interest deductibility are fought. But assume, for the purpose of this course, again, unless people want to really have a digression into interest deductibility, assume that interest is deductible when you see interest on a debt. And so what happens because interest is deductible is that the corporation's after-tax cost of debt financing is probably going to be lower than the corporation's after-tax cost of equity financing, even before we get to the point of observing that corporate interest rates are generally lower than preferred share dividend rates for a variety of reasons. If for no other reason than because shares come with creditor rights. Sorry, dividend and debt comes with creditor rights, and will in almost all instances rank in priority to any share, whether it's a preferred share or a common share. So you're higher in the debt stack, and so you're in the capital stack. So you probably are willing to take a lower rate because there's somewhat less risk of default. So to the extent interest is compensation for the risk of default, you have less of that, and so your cost of the amount that you would want to charge goes down. The corporation's cost of borrowing goes down. So because of that, like I said, corporations might therefore be expected to use debt financing instead of equity financing to the extent that it does not cause commercial or financial problems for the corporation to debt finance. Everybody okay there? All right, seeing no one, we can flip to slide 8. And slide 8 is talking about receiving interest and dividends. And so in direct contrast to a corporation, a person whose economic interests are not aligned with the corporation. So again, we're not talking about a single shareholder corporation. Like, let's think about somebody who is the shareholder of a very widely held corporation. They will have a strong preference to receive dividends versus interest. Interest results in a full inclusion under paragraph 12(1)(c), and it gets taxed at the top margin. Assume we're a top marginal tax rate payer. It gets taxed at the top marginal rate, which in Alberta would be 48%. In contrast, dividends get included in income, but what we're going to see is that there is a dividend gross up and credit integration mechanism. And what that does is it will result in a rate of tax that is less than 48%. Depending on the type of dividend, the rate could be 0, it could be 34%, it could be 42.31%. So a corporate shareholder with unaligned interests then is going to prefer to receive dividends as well, because the corporate shareholder is going to get the subsection 112(1) deduction on that amount instead of having a taxable income inclusion under paragraph 12(1)(c). There's effectively an in and out. The dividend comes into the corporate shareholder's income, but there's also the offsetting deduction under subsection 112(1). Again, there's part 4 tax in situations where the shareholder and the corporation are not in any kind of degree of economic alignment. So that may impact that preference, but it does potentially exist, and that preference will potentially be even stronger where the corporation's a CCPC and would have to pay tax on aggregate investment income when it receives interest from the dividend payer. There are in the Act a lot of rules that we are never going to talk about in this course that deal with taxable preferred shares and term preferred shares, which are intended to prevent, to deal with this preference for corporations to receive dividends rather than to receive interest income, instead of where they would use preferred shares instead of debt in order to achieve a better result by receiving dividends instead of receiving interest. What these rules generally would do is they would either deny the deduction under subsection 112(1), or they would cause an add back for the corporation, effectively under a different provision. So to use an example of what we're driving at, which is taxable preferred shares and term preferred shares, and why we have these rules, they all originate from the 1980s. There was lots of corporations with losses in Canada in the 1980s. And what most of our banks figured out very quickly was that if they made loans to these corporations, it would be fine. The corporations were good credit. But the borrower corporation would have a deduction, which was worthless to the corporation because it was a loss corporation. And the bank would have an income inclusion that would be interest. The banks are obviously public companies, so they don't have to worry about aggregate investment income and refundable taxes and all that jazz. But you're still paying tax back then at a materially higher rate. The corporate tax rate would have been closer to 40% back then. And so, the banks didn't really want to do that, right? That wasn't a great deal for them. So what they were doing was the banks were issuing, or not issuing, but they were acquiring preferred shares of debtor corporations or convertible preferred shares that could be converted into debt if the banks needed to exercise their creditor rights. And what they were doing was they were receiving dividends on these preferred shares, and they were taking their 112(1) deductions. So they were having no taxable income at the end of the day as a result of having received dividends. They're banks, they're large public companies, widely held, so they're not subject to Part 4 tax. So this was just a nothing, right? For them, they basically converted the interest income into nothing at the cost of the debtor not receiving a dividend and not receiving a deduction that the debtor couldn't actually apply against taxable income anyway. So we created the term preferred share rules and taxable preferred share rules to combat that kind of avoidance. The term preferred share rules or guaranteed preferred share rules, etc., if they apply, the bank in this example does not get a deduction under section 112(1) in respect of the dividend. So it basically puts the bank on the same footing as if it had received interest. The taxable preferred share rules go the other way. Generally speaking, if a corporation has paid dividends on taxable preferred shares in excess of $500,000 a year, then the dividend payer basically has to pay a tax on the value of the dividends paid at a rate of either 25% or 40%, depending on the circumstances. And then the corporation gets an offsetting deduction from its income under paragraph 110(1)(k), so that if a corporation has taxable income, it's pretty much a wash. There's a little bit of leakage, but pretty much a wash with taxable preferred shares. But otherwise, it could be a fairly disastrous event where basically the dividend payer is paying the tax the bank is not paying. So that is interesting, but broadly kind of not relevant to the remainder of the course. So that's the exceptions to subsection 112(1). So before we move on, anybody have any questions about that? Okay, seeing none, I think we can power through one more slide today. So if we flip to slide 9, we're going to start on our quest towards dividend integration, which we'll talk about the why now, and then we'll leave the how till our next class, which I think is in 2 weeks. So like we've just said, dividends not deductible by a corporation, right? Paragraph 18(1)(b) applies. It's a capital payment, no deduction. So as a result, if the corporation were to earn income, pay tax on that income at either 11%, 23%, 46 2/3%, whatever the rate is, and then pay taxable dividends to the shareholder, the result would be double tax. And if we had ordinary income rates applicable to taxable dividends, we'd probably be looking at a combined corporate shareholder rate of tax. It would be at least 55%. If we were talking about investment income or general rate business income with no integration for dividends, we might be well over 60% in that case. So it would be significant double taxation, and given that the normal top marginal rate is 15%, that would be a very significant penalty to earning income through a corporation. So we've decided that that penalty is bad, right? Which it is. I think that's pretty hard to not agree that that's bad, where there's any degree of economic similarity between the corporation and the shareholder. So the way we want to avoid that is to cause the corporation and the shareholder to pay tax at combined rates approximating the top marginal rate for individuals. And so, we talked about this earlier, that there's a few ways we could have done this. We could exempt dividends from tax if we just applied corporate tax at the proper rate. But that doesn't really work, because then we'd have too high a corporate tax rate. We could have corporations as flow-throughs and then just tax people immediately on their proportionate share of the corporate income, like we would with a partnership. But again, that causes some weird administrative problems with non-residents and tax exempt, et cetera. So we didn't want to do that either. So we've decided we're going to go for integration as our tool. So again, why are we doing this? Well, the answer is neutrality, right? Like, we don't want people to adopt suboptimal business structures for tax purposes. Practically, neutrality is important, because if you want to have a corporate tax base, especially from private corporations, you will destroy your corporate tax base if it's non-neutral. So in the US, you could see how this worked. Actually, it was much worse before the 2017-2018 tax reform. So pre-2017-2018 tax reform in the US, the top corporate rate was 35%, and dividends were taxed at an arbitrary rate that was basically up to, once you factor in the net investment income tax, which is also known as the Obamacare tax, it would be up, dividends were up a rate of up to 23.8%. And so you also have to factor in state taxes as well. Those were just federal taxes. There was state corporate income tax in all but like 6 states. And there were state personal income taxes in almost any state that anybody would actually want to live in. Although some people like to live in Texas and Florida because people are strange. But generally speaking, any state you'd want to live in had personal income tax as well. And so the rates actually got quite a bit higher on both the corporate rates and the personal rates. And what you would see in the US, especially pre-2018 is that almost all business income that was not being earned by public corporations or non-resident controlled corporations was being earned by flow-through entities like LLCs, LLPs, LPs, LLPs, S corporations, etc. And it would end up on personal income tax returns at the end of the day. And so the corporate income tax in the US basically didn't raise as much money as anybody thinks it does, or thinks it would have, because it was only raising corporate tax from public corporations and non-resident controlled corporations, which, again, in Canada, we don't really want to get into that situation. We don't want to have this multiplication of dumb entities, types, and we like our corporate tax base, generally speaking. So we want neutrality because we don't want people to be carrying on business through limited partnerships or something instead of just using corporations. And so integration is the key to preserving neutrality so that we can have our, people can adopt the optimal business structure for commercial reasons, have the same tax result, and so that we don't overtax people, et cetera, or just otherwise have to create flow-through entities. And so full integration, which we've decided is a good thing, a couple ways we could do that. One is we could do what the US does, and we could just have flow-throughs, right? We could have things that are corporations, like LLCs and S corporations. I mean, LLCs are in the US not corporations, but functionally they're corporations, or S corporations, where it has the same upside as corporate form for commercial purposes, but it has flow through for tax purposes. So you achieve perfect integration, everything ends up on a personal return. The other thing we could do is we could do what the US does with actual corporations, where you would have a corporate tax rate and then you would have an arbitrary rate on dividends. So in the current US regime, which may or may not change in the forthcoming weeks, who knows, but you have a current corporate income tax rate of 21%, and you have potentially state tax on top of that, but then you have a fixed dividend rate at basically 15% or 20%. And so at the end of the day, when you have a top marginal rate of 37% federally, you get to about the right result with just sheer arbitrary numbers in two places. The final alternative is to do what Canada, I guess, well, there's two alternatives. There's the really, really, really ridiculously complicated one, or there's the one that Canada actually does. And this is to do partial integration. And partial integration treats corporations and shareholders as a separate taxpayer. So shareholders are only subject to tax at the time they receive dividends from the corporations. The corporation is just subject to tax on its income at a rate of our choosing. But we also reduce the shareholder level tax when shareholders receive dividends in order to account for the corporate tax that was paid by the corporation when it earned the income in the first place, that formed the retained earnings from which the dividend was paid. So that's what we do. And so we're going to see in basically the rest of this corporate distribution unit is we're going to see how dividend integration works, how we get to a result where we're giving shareholders credit for the corporate tax that was paid by the corporation before it paid a dividend. Or at least notionally, we expect was paid. It wasn't always paid, but as we're going to see. So, do we have any questions before we wrap? Okay, seeing none, I'm going to stop recording.